Welcome to this episode of Next Exit, where we talk to high-performance enterprise CFOs to hear from them direct how they operate at that level. Today, we have the Equinix CFO, Keith Taylor. Keith, welcome to Next Exit.
Thanks for having me, Dan. Looking forward to spending some time with you today.
Thank you. Before we begin, Keith, I've done some research and it looks like you've been at Equinix for quite a long time. I was trying to look up a CFO who's been in their role for longer, and there's someone at Costco who's been there for 40 years, and someone at Berkshire Hathaway. But apart from those two, you're the longest tenured I could find, and that's extremely impressive.
Yeah, no, it's funny. Well, Dan, I don't know if you want me to respond to it other than the fact that, when I run into groups, I live in Silicon Valley, and people ask me how long I've been at the company and how long have I been the CFO. They go, "What?" But because it is atypical in this part of the world because there's so many great companies around, and not that people tend to move around just to move around, but they do move around and take on different roles. And so I've really been happy to spend time with Equinix and for his full journey from basically an angel invested company to where it is today, $100 billion enterprise.
Yeah. Awesome. So I guess if we start at the beginning, I couldn't help but notice it looks like it was started in 98 and you joined in 99 and they IPO'd in 2000.
Yeah, I was interviewing with Jay and Al, who were the two founders, back in 98, and I ultimately took the job and started it in February of 99. And you're right, we did an IPO right out of the gate in August of 2000. Quite openly, they sort of the last, that time when the dot-com bubble burst, it was the last major technology IPO to hit the market in August of 2000. And from that point, we fought for our lives because just the way the market had evolved, that we had a great business, but quite frankly, our customers were failing quite rapidly. And that creates a problem for a company of our size with no revenues, or limited revenues, I should say.
Yeah. So going back to that in the 98, 99, what was that like? So they'd started, it seems like they got to the at least 7 figures in revenue pretty quickly. What was your career before then, and what made you want to join a fast growth startup?
Well, I'm a Scottish-born Canadian that I got my chartered accounting degree in Toronto. I worked for originally Ernst & Winnie, and then it became Thorne Ernst & Wade. So from there, I knew that I always wanted to follow technology. I realized I didn't want to be an audit partner, quite simply. And that was an easy decision when I look back with, particularly given the regulation that has come into play in the public accounting field. So I wanted to follow different paths. And so for me, it went from chartered accounting in Toronto to working for one of my customers, or clients, I should say, called Becton Dickinson. It was a New Jersey-based or headquarter-based medical device company. And so I worked for their Canadian subsidiary, and I put my hand up and I said, "Hey, I'd like to try something different, and I'll go anywhere in the world." And I was recently married, and my wife was gung-ho for it. And so they said, "Well, you got to move to the corporate headquarters first," which we did. And that was my journey into the United States. And so I did that 5-year stint with Becton Dickinson. And coming to the US, I really liked what I was doing, but it was such a huge company, at least from my perspective at that time. And I got an opportunity from my uncle who had just moved from Scotland. He came to California. He says, "I need somebody that I can trust because we're going to do a lot of business in venture funding in Asia, and I need somebody to watch the money." And so he hired me, so I left Becton Dickinson to join him and started with a company called International Wireless Communications, which failed in the Asian currency crisis. So I went from a difficult situation ultimately to Equinix. But I'll say there was a couple of things that are really important. And number one was when I went to Becton Dickinson, I was following a path that made sense because I thought diagnostics was the really big thing at the time. And I wanted to follow a company that was in the diagnostic field, and that's what I did. International Wireless Communications was really about, and I think I just call it IWC. IWC was really about wireless. And at that time, it was wireless, trunk radio, cellular was just coming into play, which is an odd thing to think about today. Trunk radio, paging, and GSM. And so I joined that company, but it failed because of the Asian currency crisis, because our business was in that part of the world. And we're borrowing US dollar and the currencies got crushed. And basically we could no longer meet our needs. And it was coincidental that the lawyers of that firm, which was a great, well-funded, or at least early well-funded firm, they introduced me to the two founders of Equinix, who just closed their angel round of funding at, if my memory serves, $220,000. And I followed that company because it was internet-based. So going from diagnostics to basically wireless to internet, what felt like the right thing to do. And probably today, a lot of people are talking about AI. And so they'd follow the AI path, but thankfully I'm at the end of my career. So I have the benefit of just, working in a company that's just awesome. And I can certainly talk a little bit more about that.
Yeah. Well, you're in data infrastructure now, which is also booming thanks to AI. So it's not a bad place to be.
Yeah, it is. And we think about it as in digital infrastructure, which is really all things digital. And the world is increasingly becoming more digital, as we know. In our every day-to-day lives, we see it, particularly on our mobile phones and our different products, right? And so we live in a very digital world, and it is increasingly more digital, and AI is only going to exacerbate that. And so we feel like we're very privileged to be in this position.
Yeah, of course, of course. So if we go quickly back to '98, the company was started, small amount of funding. What was the offer to you to join? What was your goal? Was it to get to an IPO quickly?
Well, we knew we wanted to be an IPO company. Again, there's a lot of these technology plays at that time. Again, we were struggling at the company I was at. We knew that it was going to be tough, but you saw all these these soon to be internet oriented companies start to show up, and there's a lot of day trading people. Whether it was on the sort of E-Trade platform or the Charles Schwab, whatever it was, people were starting to do things, and so you're distracted. You're looking somewhere else, right? And that sort of I wanted to look at that company, and so we knew that if I could get to a company that wanted to get public, I thought it would be really good for us. And so when I joined the company, immediately out of the gate, that I asked the founders, "What do you want?" And they wanted to get the company public because they saw what was happening. And the other thing that was really important is the tremendous amount of capital that was needed for the business. You had to get to the public markets because, again, we had very low revenues. In fact, we went, if my again memory serves, when we went public, we had $800,000 of revenue, which you couldn't do today. Now it ramped up really quickly, but that was you go, wow, that's an incredible thing. That was I think our June 2000 quarter, and you go, wow, that is really, really low. So you couldn't do it. But I would just say that knowing that we wanted to do that from the get-go, I started to build the team. We realized that we wanted to sort of install or implement basically an application. We're working on, it was like QuickBooks to start, right? It was a small company. And then we went to, so we have to put in an ERP that makes sense. That's something that we can grow and scale with. So 25 years ago, it was Oracle. And we put that ERP in, which was probably a little bit overpowered for basically the size of our business. But then we set the structure, and then we've run with that ever since. And so we've been on that platform for 25 years. But that was really the sort of one of the ideas of what do we want the construct of the financials to look like, which is really cool to think that what we manage today is I can picture myself sitting in the room saying, this is what I think we want it to look like. And we still use it today. And that's how we go to market. And in many ways, we created the industry. And so it's something that I'm tremendously proud of. So it was really about the foundation and making sure we knew what we're pointing at. And that was one of the key sort of takeaways for this sort of conversation here.
Yeah, sure. So what was the headcount at the time back in 98, 99?
Well, I just had an event with my founder, and one of my founders, unfortunately, has passed away. He was the older of the two. The younger man, he's about 10 years my junior, and I just had him at my global finance offsite, and we talked a little bit about it. Let me just step back. The vision at the time and the expectations were very, very different on where we were at the time to where we are today. But there was an underlying expectation that we were going to become something formidable. And I'll sort of tell you a funny, like a little bit of a funny story. Al Avery, who was the CEO at the time, he says, "Look, I want to build 50 data centers across the world, and I want to spend $8 million in the market, in the market per data center. So that'd be a $400 million investment. We can put one building up today, without spending $400 million. Just the scale and size of the internet and where the business took. But I would say that the realization of coming from an angel-backed business to doing some funding that, some Series A, B, and C. Then we put high yield debt on the books at 13% all in, and then we raised some term debt. We really found ourselves in a little bit of a pickle. And so taking all that capital, just the sheer size and scale of our capital demands were so high that, we really, despite having gone public, we're under pressure almost immediately out of the gate. And there's a whole bunch of stories I can tell you about that. But overall, I'd just say it was an interesting time, and I can't remember if I answered your question now, so I apologize.
Oh, it's just I was wondering what the headcount was when you joined. What employee were you?
Yeah, sorry. So that time, I was roughly I started with, there's roughly 10 of us. I always say there's 10 of us around the table. And we had an interim, or sort of a hired CFO, sort of a hired gun, awesome guy. And he was the one and so we know that we ultimately needed to find a going public CEO, which we did. And then we also had to find a permanent CFO, which we did. And I worked for that person. And then ultimately I replaced them. But there's 10 of us around the table initially. And so that would be in the February of 99 timeframe. Probably by the time we got to the July timeframe, we're up to 50 or 60. And then going public, we're probably in the 300 person range. So we moved quite rapidly. But having said that, it was not easy. And then we had to make some really tough decisions to survive. And we survived. And, there's a beautiful story about perseverance, grit, and effort that really allowed us to be where we are today. Because otherwise the banks would have killed us in 2001 and put us into bankruptcy.
Yeah. So can you tell us about that? So post IPO, you've got the capital. You mentioned you were using debt and times were tough. What was the capital going on, and what's causing the squeeze?
Well, at the time there's a couple of things that, there's always these great learnings in life, and one of them is your capital structure, and it has to be suited for the time. And we're seeing all sorts of examples of what capital structures can do even today when you think about AI and the amount of investment that's being made. But back then, I think the biggest failing was we put in term debt. We put in some high yield debt, but the term debt was the one that was pre-public, and it was expensive debt. And we didn't have. We're taking all the capital we raised in the IPO to fund the build out of our data centers, what we refer to as international business exchanges, and we couldn't pay back the debt. It was that simple. And their view is, you need to pay back that debt. And we say we can't. And I remember, having these dialogues with the bankers, and I'm not going to mention the banks, but they said, I'll tell you a different story about that. But the bank said, we want our money back, and that was when the dot-com bubble had burst, and so all these companies were failing, and it really mattered for them to get their capital back. So we went from, good banking relationships into their workout group, and they were less nice people. Let's just put it that way. And so they basically wanted the money back, or force us into Chapter 11. And so we fought really hard not to do that. But the biggest issue that we had was a capital structure that was, I call that upside down, that we never should have put in term debt at that point in time, because it had the requirement to repay. And we did what we call pick interest, so pay in kind. We just accumulated the interest, but at some point you have to pay back the debt, and we didn't have the capital. And so that was the sort of realization. Number one, I'm never going to do that again. Number two, I'm not going to draw down on the debt when I can, just to put money into my bank account to weather the storm, because that makes banks really, really angry. And so that was another great learning. And then number three is just, for those banks that didn't want to negotiate or work with us, I have a really long memory. And so they didn't do business with us for 20 years, even though we're growing quite rapidly. And they know they exactly know who they are. And they said, and it bothered them that I was the CFO of this great company for so long, because they knew I was their blocker. I said, I remember what you tried to do to me. And, even though I'm what I think is a good Canadian, I'm born Scottish. And so I always remember.
Yeah, absolutely. Was it was it the same people, or are they since retired? Is it just the same bank?
And they've all retired.
Yeah.
Yeah.
Okay.
They've all gone elsewhere.
Yeah.
Um,
But it's you're still blocking the bank.
No, I got to tell you, after 20 years, they kept on knocking at my door. Somebody new came, and they said, look, everybody that did that to you, they've all gone. And I said, yes, but it tells me a little bit about the bank I'm dealing with. But ultimately, I let them do a transaction for us, and it's a great bank, and they give great advice. But I did remember, and it was very painful because, we actually had to find a buyer to take them out, and we took them out at 60 cents on the dollar, which was great at the time. And the buyer was a friendly buyer. Doesn't mean that we didn't have work to do, because we had to make some really tough calls. As I said, we were expanding into Europe at the time. We're in the big four markets: London, Paris, Amsterdam, and Frankfurt. And we had to stop that, if you will, soon after going public. And so you go back to a landlord, particularly there's one in Park Royal in London, and we had taken down their plant and we're converting it to a data center. We tore down, half the building. And so we come to him and said, hey, we got a problem. And he goes, yeah, but you tore down my building. But I said, look, here's where we're going. So we need your help. And so many people came and helped us. They got warrants in exchange. But, the ultimate sort of, let's say, negotiated settlement with all the interested parties, because we didn't want to chapter the company, was they got warrants in the new company, or in the sort of the restructured company. But we had to deal with our high yield bondholders, who we basically paid back, our term lenders, who they ultimately got paid back, and or converted into equity. And then we did a 32-for-1 reverse split, a three-way merger, and negotiating with NASDAQ all simultaneously. And we got it done. We closed that deal on December 31 of 2002. And by January 1 of 2003, we saw the light. And then we went and raised another $10 million just to make sure we had cash. And then we didn't look back. And until last quarter, we had 88 straight quarters of top line revenue growth, and we're a $100 billion business.
Wow. Wow, that's quite a story. That's quite a 2-year roller coaster, 2 or 3-year roller coaster.
It was very painful, 2 years. It really was, from August of 2000, which was really hard, to basically restructuring the business. And again, not in a bankruptcy setting, but getting the capital structure right and focusing on what was important. And the proof point really was we knew we had hit the right mark. We had the wrong capital structure, and we had the wrong type of customers initially, and that created a problem for us.
So that was a very strong lesson about debt there. So you got the debt, you couldn't pay it back. Was it that the customers had all fallen away, or was it to do with the construction took longer, or what was it?
Yeah, I think this, like anything, as you appreciate, it's a combination of things. The customers failing rapidly was something. He had pets.com and giftcertificates.com and all these companies. And the thing was, they all had raised money and they wanted to deploy. They knew what they needed to do. But they had their own struggles. And I think part of the challenge was when you walked into today a data center, or what we call an international business exchange, as I referred to before, is full and is humming. That's what you see today. Back then, you'd walk to a cage and you go, well, where's their equipment? And they don't have any equipment. And so that tells me something, that they're in a world of hurt, or they've taken down their equipment, or they've done so. So it was really a combination of customers failing, a capital plan that was quite substantial, that we're investing heavily. At least at that point in time, it seemed like just a tremendous amount of capital. And then basically the capital structure. So it's the customers, the investment and the capital structure that really put us in pressure. And I would say, like anything at the time, we didn't realize how fast things were going to move. And it's very different than today. Things are moving really, really fast. But back then, things were moving fast enough. And because of all these failures, it was just trying to figure out, how do we survive? And so we did a good job of restructuring the balance sheet with everybody, and basically, for all intents and purposes, wiping out the equity with the 32-for-1 reverse split, dealing with NASDAQ, finding some capital in Singapore because nobody in the US would invest in us, particularly if we didn't file for bankruptcy because they wanted everything cleaned up, and doing the three-way merger. And that got us into Asia. And that's why we're in Singapore, Hong Kong, Tokyo, as some of the major markets for our Asian business. So in some ways, all the bad also turned out into really good because it created the largest global platform in the world. And that's what we live off of today. And just we're continuing to expand and scale it.
Yeah, phenomenal. So, you've IPO, you've got into trouble, you've done the reverse split, you sorted out the debt. It's the 1st of January 2003. You've then had huge international expansion. Can you tell us about that over the next years?
Yeah. Ultimately, as you grow and scale, and you really have to follow the customers. And the foundation of our business is really about networks. We're the largest digital infrastructure company that independent. Let's say that because there's some massive companies out there now. So we knew that we wanted to continue to grow and scale the platform, and our customers were moving to different parts of the world, and so we wanted to follow them. And it also gave us great visibility. And I think what was important with networks being, again, the foundation of our business, we're basically the intersection point of all things internet. Whereas the core routing infrastructure of the internet sort of generally resides inside Equinix. And why is that different? So back in 2001, we wanted to be network neutral. There's this massive company called Exodus, and they had a network, they had co-location, and they had managed services. We said, we just want to do the co-location. We want all the networks to reside inside of us independently. So instead of everybody digging up the street simultaneously, why don't we give them a neutral location for them all to meet? And that's what we did. And we did that in the United States and in the 6 big markets. And that was the foundation for the future. And so by creating an environment where the networks could come in and create the foundation, and everybody would want, therefore, to get close to the networks to distribute their content or eventually become financial and electronic traders and to the clouds and today AI. We went through all these shifts, but everything sits on top of the foundation, which is network. It's the diversity of networks. So following them wherever they went. And we became that player, particularly in the international markets where US companies wanted to grow and scale. And one of the core metrics that we share with even the street today is 90% of our quarterly growth comes from customers who are growing with us, from the same customers, and just continue to grow and grow and grow. And so then we created this global platform. Had we not had that struggle, I'm not sure we'd be in the markets that we're in today. We definitely wouldn't be in at the speed that we travel. And our competitive landscape has shifted because we had first mover advantage. And so today, with all those foundational networks inside us, which is awesome, the clouds ultimately, when the clouds came to be, they needed network because they need to distribute their cloud services to their customers, who are the enterprises, who are the content companies, the Netflixes of the world, or the AWS, the Azure's, GCP, OCI. These are all the big cloud companies. They needed a foundation to sit on top of, and they put their core routing infrastructure or their network nodes, or what we call availability zones, right inside Equinix. And that sort of created the next leg up, which is basically you get the advantage of network, but you also get the on and off ramps to the cloud. And then we do a lot with cable landing stations, both origination and termination. All these intercontinental or transcontinental cables that are laid on the seabed, they terminate, or they need to originate and terminate, and we're basically one of the largest providers in the world for that opportunity.
Wow. Okay. So when looking at international expansion, we're looking at your customer base and trying to be one step ahead of building the infrastructure to where they would want to be.
Yeah, and then it's really about scale and size because customers like proximity, and as you can appreciate, they want to be as proximate to their infrastructure as they can. But like anything, we're a multi-tenant data center. It's like just like a large hotel. At some point, you start to fill up the hotel, and you say, "Well, I want to be in the room next door." I'm sorry, with that somebody else is in that room, if you will. And so that was part of the challenge. And so you had to then think about, well, how do we build on a contiguous basis and or proximate? I mean, contiguous would be ideal. Proximate is important because really you're traveling at the speed, or you want to be as proximate with the speed of light. And there are some, if you will, physical or technical limitations on that. And so now when you talk about Equinix, say the largest data center market in the world is Washington, D.C., the largest. And we're putting up our 22nd building, and we're small there. We're tiny compared to all those that have built around us, largely because they want to be proximate to where they can aggregate their data and they can distribute their data. And that's the value of Equinix. People build around us and they create this, if you will, magnetic pull. But that's also the challenge, right? Everything, there's always the, if you will, the blessings, but the curse of success. Because the curse is everybody bought around us, we don't get land proximate to us anymore. It's hard to find. And today's even harder with energy and, the availability of energy. And it's not that there's not energy to generate or create. It's the ability to distribute the energy to the places that need to be, or where it can be consumed. And that's why instead of building and let the energy come to you, you go to where the energy is. And so it's a really interesting life today, very different than where we were, 25 years ago.
Absolutely. So that's some strong network effects you got there. So, in terms of scaling out, you've done quite a few acquisitions over the years. Have you been growing? What percentage of your growth was through acquisition, and how much was organic?
I can't tell you, I actually don't know what percent of our growth is acquisition because, as you know, when you buy a small company and becomes the foundation of something. But what I would tell you is, just for sort of order of magnitude, the company's roughly a $100 billion enterprise today. And I would say that we invested probably somewhere around $15 billion in our acquisitions, that order of magnitude. And so when you look at the underlying value, but a lot of that is still growing today because you buy a building and then it becomes the foundation for you to get into, say, the Brazilian market, where you bought a building in Rio, a building in Sao Paulo, but now we've got multiple buildings in each market. And so, yes, we got there because we acquired a company, but all the investment hence was really coming from, if you will, the combined business. And so that's the benefit. First mover advantage, you grow and scale, you've got your anchor data center, and then we connect them all together through what we call the Equinix fabric, so that they're as if they are one. They're proximate enough that the fabric can extend around the world. So we have 275 plus buildings in, let me just see, 76 markets in 35 countries. And so we keep on investing, and we just did a recent acquisition in the Philippines with 3 buildings. We're building now in Bangkok, in Thailand. We just opened up our building in Chennai, India, in Jakarta, Indonesia. We're investing heavily in Malaysia. We want to get to the Middle East in a more meaningful way in the Kingdom of Saudi Arabia, which would be, we think, a great market one day for us. So it's looking at where's the traffic going to move and where do we want to play. There's some markets that are very difficult for us, though, that the structure is such. In some cases it's hard to build. In other cases, it's just the structure is hard to operate in, and so we don't put a lot of capital in some of the bigger markets like China. We want to continue to grow and expand in China, but we're only in Shanghai, and it's hard to operate in Shanghai. And so, we're going to continue to focus on other markets, where we can put the capital to work. And, eventually, if you will, the structure of some of these markets shift, then we can always go back and be a relevant player. But today it's just a bit hard in some of the markets that we operate in. I'm not convinced we need to be in all the markets that we actually serve today, quite openly. And so, over time, although we bought a lot of companies, that came with a lot of markets that you say, do I really need to invest more in that market? We bought Bell Canada's assets in the Canadian market, and I think we're in 10 markets in Canada, 9 or 10. Um, but you want to be in Vancouver, you want to be in Toronto, you want to be in Montreal, you want to be in, say, Calgary. But do you need to be in all these other markets? The answer is maybe yes, but the answer also might be maybe no. And so you invest in the markets that you need to grow. And so that's sort of, if you will, the challenge of acquisitions when you acquire things that, and we call them gifts with purchase. And sometimes we sell those off, like we did with our Sevilla asset in Spain when we bought a company in Spain.
Before we spoke, I was thinking about different waves there might be in terms of demand for you. Obviously, the first is the internet, and then next the surge of cloud would need much more compute and data centers. And now we're in AI. We're talking a lot about geographical expansion. Are you seeing the future of the expansion in the large number of underserved countries looking forward? Is there a certain saturation point, particularly in the United States or in Europe or parts of Asia, that might have happened 10 plus years ago, and you now have to be looking elsewhere?
No, I don't. There's not, because just even think about the United States, which is one of the most developed markets in the world. Uh, just with the sheer demand coming from all things digital, from the content that we consume to artificial intelligence to financial and electronic trading, the networks which were the foundation to our business have to grow and scale. So the most maturest of industries still have to grow and scale in your business to meet the demand of their customers. So we're not at a point of saturation because, eventually AI will develop into other things. And I think about autonomous driving as an example, is only starting to take root. Uh, I have cars driving around my community here that you look over and there's nobody in the driver's seat and you go, wow. It's a wow to think what internet has allowed companies to accomplish. Um, and that happens, I think, maybe in China today. It happens here. Uh, but think where else that will grow. And then there'll be other technologies. But suffice it to say, I think what will happen is there'll be more and more digital applications that come from AI. There'll be new businesses that get formed. And so saturation is, I always remember the discussions of old where our investors were saying, but how can this continue to grow? That's when we're a $1 billion company. Now we see sort of line of sight to be a $20 billion company, and we're only $10 billion today because the sheer scale and size is at levels nobody ever anticipated. We just didn't appreciate it. And so fiber companies have to build more infrastructure just to meet the demands. If you will, the amount of data that's coming through what is commonly known as the pipes is just substantial. And you have to have new electronics. And the energy that gets consumed with those electronics are substantial. And so although things are operating much more efficiently, the quantum is just that much greater. Then eventually you're going to get into quantum computing. So you go from one thing to the next. And so we followed all these interesting sort of trends, and we continue to look at what is next. And I would just say that, we'll be at the front edge of it, but you don't lose what some companies come and go, as we know. They get replaced by others. But we live in a multi-tenanted environment where we have 200-300 customers inside our I'll call them network dense environments that we connect everybody to. And so you have the ability to just replace them with somebody else. And you have to continue to work on, a data center needs a lot of predictive and preventative maintenance. Sometimes you have to you have to replace battery strings. You might have to replace motors and generators. You might have crack units for air conditioning. There's things that you have to replace, but these could be 50 or 60, 70-year-old assets at some point. People say, well, how long are the assets going to survive? I go, I actually don't know. But what we believe is that these could be 40, 50-year assets without a large redevelopment in the property. It doesn't mean don't have to invest in things, because things fail over time. Even though you don't, people are really concerned about the diesel generators that they get attached to the building, but they might run less than 1% of the time. There's just failovers when the grid fails. And part of what we're trying to deal with in the United States um, quite recently is that the regulation is so difficult in the US, and the access to energy is limited. Um, and you have all these diesel generators that are sitting there that all have, the pollutant controls and noise attenuation. Just there's things that they would be a perfect example of when a grid falls into trouble. Working with the utility, you could go to generation, but that's just the regulations don't permit for that. And so I think when you listen to Secretary Wright, who's the Secretary of Energy for the U.S., we have to find ways to not be disrespectful to the environment, but also recognize that we don't have to not use energy, because there's a lot of energy that's sitting there waiting to be used and it never gets used. And that's just sort of the nature of the industry a little bit, but it's a real opportunity for our company. And that, we could go down a completely different rabbit hole in this one if you want, but it's probably not a place that we want to play.
Yeah. No, I think what something I would like to dive into. Did you say you've had 88 straight quarters of revenue growth?
Yes, more than any other S&P company, and we just broke it last quarter. And we knew we're going to. But eight. Can you imagine? And people said, "Yeah, but your recurring revenue model, your numbers should continue to go up." I said, yes, but you have to remember, there's non-recurring revenue that's swinging around. 60% of our revenues reside outside of the U.S., and so you've got currencies moving. So to have the consistency, and the only reason that we failed is we did a really large deal that in the fourth quarter of last year, we got a large fee for, and we knew that we wouldn't be able. We knew that fee was going to throw us off sideways, as well as the shift in currency, and so we broke the trend this year, and we're quite happy to do it. At some point you have this record, but you're going to break it at some point, and so we've just stopped talking about it and said that we expect that that'll be our last quarter of top line growth because of the non-recurring nature of some of our business.
So you've been with the business since 10 people, and you've had the same Oracle system from then to now.
Well, the same ERP, but it's obviously we've had to invest in it and scale it and grow it, and we just did a 3-year re-implementation and moved our Oracle on-prem to basically into the cloud. And so we use Oracle Cloud, which is in many ways, it's simplified how a business operates. And more and more companies are moving their ERP into the cloud. We're one of the major companies, one of the first ones to do that with Oracle. And it's a lot of work. It's hard. And things aren't always performing the way that you expect, but it's about lifelong learning, right? And one of the expressions I use from a friend, he gave it to me, which I think is so true in the financial space, is we have to do better and better, and we're never done. So we call it better, better, never done. That we always have to look for ways to do it better, and the recognition we always have to improve, because as the business grows and scales and different things come into play, you got to deal with that, and so you're never done. And even things that you thought were operating good or well, or met the needs of the organization, you realize things have to change at times, and you evolve, and because the business evolves, and that's what we've done.
So you've been running the business despite all the different technological innovations that would change the demand for compute, data centers, geographical expansion, currency situations. One would expect quite a lot of volatility there, and you've had pretty strong revenue growth quarter on quarter, year on year for well over 2.5 decades. In terms of your role as CFO, what are the key things you're tracking and looking at every day, week, and month to make sure you're on track and avoiding the volatility, making sure you're pulling your revenue forward and keeping the company predictable?
Well, the benefit we have is we have an environment that is increasingly becoming more digital. So we are in a very fortunate space And the world needs more data centers. And I know that sounds really harsh at times, but more and more, there's going to be more and more demand for data centers. I mean, think about one day we're going to go to, there'll be robots, and you might even have them in your homes. And just think about the underlying demand of what is needed. And so technology is going to continue to grow and scale. I would just say that uh, for me, the easiest way to describe it is demand is unsatiable and the supply is limited. And so that gives us a lot of confidence that we need to continue to invest in the future, but be very disciplined about it. There's more capital coming to the space than I think anybody's ever seen in the history of mankind. And so we have to stick to our knitting, be close to our origins, and adapt to the environment that is shifting around us very, very rapidly. And I've always said to the team, the predictability comes from understanding who your customers are and what they need and where they want to grow and scale. So surely that's part of it. Staying ahead of what the competitors are doing and who's trying to compete against us, and how that will come to be. But we also have a privilege that few have, and that is we have all those networks inside our facilities. And I'm talking about the core routing infrastructure for the internet and many of the markets of which we serve. And so can it be replaced? The answer, yes, it is possible, but it's hellishly disruptive. And so we have to we take very seriously, what we do and what we deliver to the market, because for Equinix to, let's just say simply, for Equinix to go out of business would be a very disruptive set of circumstances for the world. And we don't take that lightly. But I think the most important takeaway is understanding what your customers want and where they want it, and being very disciplined about where you deploy your capital. I think is important. But we have basically the tailwinds of many different technology trends that are very digital oriented, and you're going to need a data center for it.
I think maybe you're being too humble there, because if you look back at previous examples, what did you mention? Pets.com and
Yeah. Oh, gift certificate.
yeah, gift certificates. There are a lot of people with a tailwind, and back in 2000, a lot of those aren't around now. But it sounds like your network effects are what's really driving you forward.
Well, it is the network. It is the network effect, and so and it's not like companies don't struggle, because even like the networks today, think the large, I'll call them sovereign networks that we have around the world, from your country to here to Canada, where else. You realize that they're there, but the biggest networks in the world are not them anymore. It's the cloud companies. And so there's always this shift that takes place in the industry, and you have to be aware of, who's growing and scaling and who's not. And you have to also be adaptable to an environment where things aren't going well. Let's use content distribution. And just recently this week, and across the lagoon from where we work, Electronic Arts was taken public. You have Netflix, and we used to have Blockbuster, and they're only growing and scaling. I mean, maybe not at the same rate that they were, but everybody loves the different applications that come out of content distribution. Whether it's Hulu or it's Netflix or it's Paramount Plus, or you name all the companies, I think of all the different applications around the world where the consumers will continue to adapt to how they take in their data. And I think that's what, we thrive and live on, but we have to be adaptable and aware. I think the awareness of what's struggling, so that we can either help them, or we're at least aware of what's happening. So when we know that when capacity is coming back. And I would say, part of being, I think, good stewards for our shareholders is having enough predictive information to understand, are we going to lose something, our customer? And so we have analytics, and through AI, and we have, our new CDIO is very AI, what I call AI forward. that, she is building basically applications that allows us to look at parameters that will give the sales reps, information so that they can either manage the customer, maybe help them downsize because the commitment's too big for what they're doing. And that gives us, again, the visibility in what we need to do on a go forward basis. So there's a number of things that we're doing, Dan, that I think help the business understand. But the other thing I would say, and we all know it, the ability to build fast, particularly when you're putting up a $500 million business, or sorry, building. I said building, or in this case, right now we're constructing a $3.2 billion campus in Atlanta. There's a lot of friction between when you decide to do it and when you deliver the, if you will, the capabilities to sell to the customer. And so something just doesn't appear on your doorstep and go, or next door, and you go, oh, where did that come from? So we know who's building around us, what the size of the build is, what the access to energy, because we know where energy is limited and where it is unlimited, or at least unlimited at this point in time. And so you're paying attention, and so you have a lot of ability to predict and what you're going to do. But again, it's, as I said before, there's the blessing and the curse of our industry. The curse is that you can't just put up an asset quickly. It takes time. You have to work with supply chain. You have to get to the energy, unless you're going to self-generate, and self-generation still takes a lot of time because you got to get to the fuel cells and or gas turbines, and they have a long lead time now also in the supply chain.
So you said yourself, there's a huge amount of capital, arguably more capital than ever, moving into this market right now. What is stopping your competitors coming in and stealing your lunch right now?
Well, nothing prevents somebody from, it's like you put up a great sort of shopping mall, and we have one just down the street from where I live in California. And anybody can go put up another shopping mall, but who are your anchors? What does the asset look like? What is the ecosystem that is being created? And for us, I think it really matters. One, do you have a good asset? Are you highly reliable? Are you investing in your future? But who are your customers? And for us, once somebody builds their infrastructure, it's really hard to lift it up and move it somewhere else. And so having all those networks resident inside our facilities, having all those cloud ramps, that's what differentiates us from everybody else. And also, we're in the business of being in the business. We're not asset developers, if you will. Yes, of course, we put up these massive assets, but we're not in the business of trying to monetize. And so monetize the asset and its success. What we're trying to do is create a recurring stream of revenue for our investors, which they really like. And so I think that's one of the things I would just say. It's the look, the feel, the brand, the reliability, and the customers that make a difference. And then we connect the buildings all together again as if they're one, which of course we don't let anybody just do that. And so we have the benefit of, even when we scale to a new market, the customers there already have access to a global platform. And so they can operate around the world without ever locating a single person in that environment. So we just put the infrastructure there on their behalf.
You were talking about your investors and shareholders there. I want to touch upon being a public CFO, running your earnings calls. How do you operate that internally? You're mentioning your forecasting and the AI forward systems you're putting in place. When you're running through the quarter and getting ready for those quarterly earnings, what does that look like?
Well, in the United States, again, it's always a surprise to say this, but it's a very regulated environment. And so with it comes a lot of responsibility. And so the Securities and Exchange Commission, we file on a quarterly basis. And we have to provide that, that, if you will, that level of rigor around our business, because we follow US GAAP. We're a global business, and you got to consolidate that. And so the amount of planning work that has to go into not only the forecasting and sort of the work that gets done for the guidance, including the currency rates and the swaps and the derivatives we all have in place, but then you got to predict that, and you got to predict. And so that's part of it, is having just the rigor around our financial reporting, but also our financial planning and forecasting, because we also have to give quarterly guidance on what we think we're going to do in the next quarter and for the year. And because it is a recurring revenue model with generally, generally fixed costs, but there's some recurring costs that travel with revenue, such as utility spend. You have to predict what's going to happen, and I think that's the most important part. We've only missed our guidance once in all those years. And I remember it was the third quarter of 2010, and it was a forecasting mistake. Um, and it doesn't mean that we don't we provide ranges, but I think when I truly think about a miss, that was a miss for us, and so we take this very, very seriously. And the amount of work that we do to build up to the quarter end, we reforecast every single month. So after every month, we're reforecasting the rest of the quarter and the year. And then we have a budget that we operate with. So you have that rigor and that oversight that I just think is to a very, very high end. And we're still thinking, how do we do it faster? How do we do it more, with more, with more visibility? But customers are shifting. So much can get thrown at us in any given quarter that the regulatory environment changes, the tax structure changes in Brazil. You have a dispute with this customer or that customer where our ability to deliver was not as anticipated. There's this one-off charge here. There's a rebate over there. I always call them goodies and baddies. Every quarter, there's a host of goodies and baddies that you just didn't see coming. And running a business of our scale and size, you can no longer just rely on humans. You got to rely on the systems and the processes. And we're always working to enhance them, get smarter, get better, and get good teammates, and just continue to do what we do. But as I said, having the benefit of good forecasting and planning is the most important for our quarterly rigor.
Sure. So I'm a forecasting CEO, so I've got to dig into this. But firstly, if you've only missed one quarter, I make that as just over 1% miss. I think the market benchmark for public CFOs is around 20+%. So I think you're doing really well, according to the market.
Yeah, well, thank you for that comment. But I also know it's the model and the industry in which we live that's allowed us to be a little bit different. The benefit that we have, and as the base gets bigger and bigger, the predictability increases dramatically, right? Because it's a recurring revenue. Something would have to be very large and hit us sideways for us to miss something. So we get, that's part of the, we have the benefit of a really good business model, and so thank you for your comment, but I'm not sure that I think we do a good job, but I'm not sure, I feel for those CFOs and others who have to, their year restarts every single quarter end, if you will, because they got to start at zero, and we don't.
Yeah. So you mentioned you've got fixed costs and variable costs in terms of your revenue and the recurring revenue. How does it look in terms of like consumption-based revenue, essentially, versus the recurring revenue that you're very confident in at the beginning of the quarter?
Well, we don't do a lot of consumption-based revenue, but let me just tell you why it's a little bit easy for us. 95% of our revenues recur, and that the recurring nature of that is space and power. And the thing that utilities like about Equinix is we're very steady with our power consumption. And yes, companies go up and down at times, but when you look at the totality of it, there's a tremendous amount of predictability. So that's the variable component of our business. And so, and even energy, which is a consumptive-based revenue stream, 90% of it is fixed. It's use it or lose it. We're going to charge you the same rate, whether you use it or not, because we've built out all this infrastructure. We've built all this redundancy. We're doing all this maintenance. We're not charging you on, if you will, the electron that you're using. We're going to charge you on the fact that we allocated you that hotel room. And so whether you use it or not, we're going to charge you the same rate. So that's 90% of it. So again, you have great predictability around, the revenue model, and the cost model Yes, it moves around a little bit, but the largest piece of that is, again, utilities. It represents about 13% of our revenues in any given quarter, and it moves around a little bit during seasonal, there's seasonality in different parts of the world. But we have, again, is relatively predictable, and most of it is regulated. And so you know what you have to, you have to, if you will, accrue into your forecast.
Yeah, absolutely. So, just to dig into running a finance team, if you don't mind, how big's your team at the moment?
We're about 900.
900.
Yeah, 900. It's all aspects of finance. It is all aspects of finance. I say our biggest teams would be in the shared services areas, where we still, because we're improving some of our systems, where when we struggle to sort of meet the demands of the business, how we solve for that is we throw bodies at it, and um, and there's things that we know we can do that will automate over some period of time. Um, so the shared services area would be the biggest part of it. As a business, our lead to cash, sort of, if you will, sort of, I'll call it componentry of our monthly cadence is an area where we're actually we're retooling that right now, and that's going to help us tremendously. But it's treasury, it's tax, it's all of the derivative work we do. It's our accounting, our shared services, our investor relations, our planning teams, and so it really is sort of cradle to grave. And so it's a big organization, but we also operate, we have what I call presence in all these countries, and we have physical presence. And so we have to manage it from a different perspective. And we're also a REIT in the United States, a real estate investment trust, while in Europe we're a commissionaire structure. And so the complexities of our close are quite high. We have hundreds of legal entities that we have to solve for, and everyone has to be accounted for every single month. And so that's, the part of the challenge. So we want to automate that as much as possible.
Of course. So you said there's a challenge. You throw bodies at it with the view that it will be automated over time. Now that's very pertinent in the current world of AI. People often say it might not be coming after your job, but it's definitely coming after your role. And people have to be flexible in terms of what they turn up to do. Is that how you see things when you function?
It's a bit premature because I spend a lot of time with, a lot of the CFOs in the area, in the technology space. And we're all looking at ways to use AI to, if you will, free up the mundane, and there's certainly some, if you will, some jobs or tasks that will one day be replaced with AI. But that, we want the employees to grow and scale with new technologies, and giving them the tools so that we spend more of our energy, therefore focusing on value creation versus the mundane. Um, but I can probably comfortably say today that people aren't losing their jobs in Equinix because of AI. But I think at some point in the future, we have to make sure that we train and adapt the team, particularly those that are most exposed to AI-oriented tasks, to do other things inside the business.
Yes, exactly. Yeah. So that was the route I was going down. Might not be coming after your job, but the most mundane tasks that you've got, hopefully for everyone, they'll be replaced, and you have to be looking elsewhere in the organization.
Yeah. Well, and the interesting part, Dan, is some people like the mundane. Maybe you and I don't like the mundane, but
Yeah.
some people like, just the day to day, and they clock in at 9 and they leave at 5, and they want to do that. They don't want to learn new technology. But we got to help them along, right? Because whether we like it or not, the world is shifting, and it's shifting, at a really fast pace. And particularly in this part of the world that I live in, just you see change all around you all the time, and you hear about things. You go, wow. And so it's exciting, but also, I've got kids. I think, well, how are they going to play into the future? And you know, and they're all technology kids, so they're going to find their way, but it might not be in the business that they once thought they were going to be in, which is okay. But I think, whether it's, your family, or whether it's your friends, or whether it's your employees, I think the world is shifting, and so you got to adapt to the new environment.
You mentioned that you're talking to a lot of CFOs in the Bay Area. You've been a CFO, as mentioned, longer than everyone other than Costco and Berkshire Hathaway that I could find. What is it that makes a great CFO? And what's made you outperform the average tenure by many multiples?
Well, thankfully, I've just joined. My fifth CEO has just joined the company just a year past. Her name's Adair Fox-Martin, who came from Google Cloud, so GCP. She's an Irish national that moved to the US. And so I was reflecting on it because people ask me all the time, well, how do you, eh, CEOs generally like to bring a lot of their own people with them, or they have change. And I would say simply is I'm adaptable. Two, I don't want their job. Three, I'm going to cover their back. And four, we've run a good business for the last 25 years, 25 years plus. And I think the combination of all of that and my willingness to learn and grow and adapt to different people's styles. And again, I don't have a big ego. I care a lot, but I don't have a big ego. And people want to do things differently. That's fine. You guide them on what you need. And again, we have a big, strong business model that's performed. And so there's some element, yeah, you want to change and tweak and modify it, but a lot of stuff's working really well. And so that's one of the benefits I've had, as just like the industry has grown and scaled, and I've been able to grow and scale with an industry. But I would say the other thing that is probably important is always wanting to know and understand. I think one of the great learnings I had way back when, and I still use it today, is I want to understand why something happens. Why does technology happen that way? And and so when I think about our financial products we use to grow and scale the business, or I think about the technology why do we need to do it that way? So being inquisitive so that you understand it. Remember the days of schooling where you memorize things, but you don't understand why it works. I think understanding why it works really matters. And that allowed me to make decisions around what type of debt structures we use. Convertible debt, the cost of a convertible debt instrument is very different than straight debt. And what is the point of ambivalence where what has to happen for one to be more expensive or less expensive than the other? And so you think about all of those things and where you're taking your business. And I would just say the adaptability of thought and hiring really good people. I was recently at an event and they had recognized me for something. I said, "It's not me. It's all those people that are sitting in that audience. They're the ones that are running the business." But you have to hire good people to make it happen, right? And hire people that are better than you. Hire people that fill in your holes. And I think can run the business different than you. I don't like process. I'm a CFO, so I care about process. But getting into, if you will, the meat and potatoes of process, there's people who really like doing that. I like to deal with IR and, strategic finance and our planning and the capital structure, the working with my CEO and my peers on the executive committee. That's where I like to spend my energy. But there's others who like to spend their energy elsewhere. And so understanding what I'm good at or not good at, and understanding where we need to hire good people, I think that's really important. And 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 don't be scared to hire people who are smarter than you. I always think there's a lady who I sort of share the same area in the office with, and it just I know she's just so darn smart. Um, and I think, man, it's great to have her on the team. And she's so smart, but she focuses on an area that she has passion for. Uh, and unfortunately, today is her last day because she's going to become a CFO somewhere else. Pardon me. But thinking about when you find somebody who cares about what they do, and we work together for 15 years, we're going to be lifelong friends. And I'm going to be there for her. She's going to be there for me, no matter where we are. But that, the confidence to hire somebody that has that set of skills and sees through a lens that in my case, I don't see through. Um, I think that's just one of the great, uh, I think, great tasks I've been able to fulfill in my career, hiring those great people. And I'm thankful for it, and I'm thankful for them. And hopefully they know that.
Yeah. Well, they will now. But I guess to look at it from the other angle, you've got plenty of people in your team. We've got up and coming finance professionals listening here. Above and beyond being a fantastic professional, how can you move? How can you move up the ladder? What would your advice be to them to get noticed and get promoted?
Yeah, I've been asked that question a few times. Number one, finance people tend to be no people. No, we can't do it. I always say, how can find a way to do it? So when something happens, don't automatically say no. Say, let me think about that. Let me figure out how we can solve that problem, or maybe if we do it this way. So being solution oriented versus non, I think is number one. Number two is make sure you sign you attach yourself to people that really are learning and growing. You want to grow and learn with them. It is about lifelong learning. It's a great expression that all paths lead to here. All the good and bad decisions I made led me to where I am today. And so I think you have to learn and grow and realize when you haven't been able to grow, or realize when you're in a rut. So what is it you can do to get out of that rut? The mundane, the monotony of some of the jobs. And so always put your hand up. I've always said that it matters when somebody says, I want to learn and grow. And I have one of my really important young colleagues who is going to leave my organization to go to another organization. And I was asking her, what is it that she wants? And it's not, she's done the job for 5 years. She wants to learn and grow, and she's going to move out of my, and so allowing for that to happen, I think really matters, knowing that you want to grow and develop your team. So I think that's important, because this person, she herself knew that she wanted to grow, and staying in the same role, it was going to be a little bit more of the already, if you will. And then, I think putting your hand up to also say, I'm willing to do that. I'm willing to make a little bit of a sacrifice. Because getting to become a CFO, it's at times it can be a very lonely place. And you have to decide, is that the place I want to be? And it's okay if you don't want to be. It's like all roles, right, in life. You decide, is that what I really want to do? Do I want to work that hard? Do I want to be on call 7 by 24? Do I want to work my weekends at times? Do I want to forgo family activities at times? But you also have to find balance in your life. And I think it's the combination of both. You have to decide where you want to play, but also learn where you want to learn what you want to learn, and move to the place that makes sense. And I love, because I'm a Canadian. I played hockey, and you go to where the puck is going to be, not where it was, because it's moving at such speed. Is Will be far behind you if you go to where it was. Um, um, so from my perspective, um, I just think it is about lifelong learning and adaptability, and the desire to grow. And a lot of people want that. It's not a given though, And again, I have a really strong workforce, probably 120 directors and above. So directors, VPs, SVPs that work for me. And you can see the ones that are going to succeed. You see the ones that are probably going to struggle. Because the other part is, people say, I want a promotion, I want a title. But with that comes responsibility. It's not just the job, it's the individual. And if the two don't meet, you're setting people up to fail. And that's not good for them. It's not good for their careers. It creates disruption in the business. Eventually, either they're gonna leave the business because they're unhappy, or they're going to be asked to leave the business because they didn't deliver. And I think that's an important aspect of making sure you're ready for what's coming. And again, I remember when they first appointed me as CFO, I go, oh, all that responsibility feels immense. um, and my friend said to me, my out of office friends were saying to me, you changed. And part of it is the psychology changes, because I didn't want to disappoint. And a lot of people were counting on me to make good decisions, so we wouldn't go through what we just went through as a company. Um, So those are the pieces of advice I would give. And um, but I think if I could say maybe one more thing, then I- working with people that you want to work with is a gift. Working from people who you learn from is a gift. You don't have to like them, but you're on the same team with them. And I've always said I want to make my boss look good. You know, I and good bosses don't take credit for other people's work. They recognize it's a team sport. And I think being as, working for that person, they're going to be something in life, and following their footsteps, I think there's this real advantage to it. And I've followed a lot of people, but I've also learned outside of my discipline. I love finance. I love accounting, but I also like knowing other parts of the business. So early in my career, I wanted to understand what others were doing and why they were doing it, because it helps you make a better decision. If you just stay in your lane, you don't get the advantages of seeing what others are looking for. And that can be very helpful, particularly when you get more senior, because you may have to make decisions that span across the organization.
Yeah. Yeah. That's awesome. Keith, look, this has been a fantastic conversation. I've learned a huge amount about data centers and energy, as well as being a great CFO. So it's been amazing to have you on.
Thank you very much, Dan. Thanks for having me on, and I really appreciate the time we've had together. And thanks for allowing me to tell you my story a little bit. And I'm so immensely, proud of the industry in which we serve, and the employees that I work with. But I'm proud of the profession. You know, Financial people are really important to a business, and hopefully there's some learning that has come from this.
Yeah, absolutely, absolutely. Thank you for sharing your stories and tips for the audience.